Let's be real, you're always being told to invest your money even when the stock market is unstable. Some even say that now is the best time to invest because prices are low. But what exactly should you invest in when you're in your 20s? Here are 8 investment ideas you should think about while you're young. You don't have to invest in all of them, but if you pick only 2 or 3 and put money into them consistently, your wealth will start to expand rapidly. Hello and welcome to our channel. In today's video, we are going to look at the best investments that you should make while you're still young. Make sure to stick around till the end of this video because this is a life-changing opportunity for you to make smart financial decisions. If you like the video, don't forget to give it a thumbs up, subscribe to the channel and turn on the post notifications. So without wasting any time, let's dive right into the video. Number 1. Cryptocurrency. Cryptocurrency is a form of electronic-only digital currency designed to function as a means of exchange. Recently, it has become a sought-after asset as investors pour money into it, driving up prices and luring new investors into the market. Many investors and traders focus on Bitcoin since it is the most liquid cryptocurrency and its price changes frequently. For instance, Bitcoin's price increased from under $10,000 in early 2020 to about $30,000 in early 2021. After going $60,000, it doubled, only to start dropping considerably in 2022. Investors who are willing to take the risk that their cryptocurrency investment could go to zero but are interested in the possibility of considerably larger returns should consider investing in cryptocurrency. Investors looking for safety should look elsewhere. Extremely negative outcomes like outlawing or strict regulation are possible with cryptocurrency, rendering any given cryptocurrency worthless. The value of digital currencies fluctuates wildly, depending solely on the willingness of traders to buy and sell them. Given the history of high-profile thefts, traders too run the danger of being hacked. And if you're going to invest in cryptocurrencies, you have to figure out which ones will survive because many of them may go away. Number 2. 529 plans. One of the best investments you can make is in a 529 plan for the purpose of saving money for college. You can start one before having children and everyone in the family can chip in. In addition to enjoying tax-free growth on your initial investment, both you and your child will avoid paying taxes on the earnings from the account as long as the funds are used for approved higher education costs. Investments made through its plan may also qualify you for a reduction in state income taxes depending on where you live. When it comes to 529 plans, you have the option of creating your own custom portfolio or selecting a fund based on when you expect your child to enroll in college. Although you have more leeway to take risks with a 529 than you would with a retirement plan, you should still tread carefully given the relatively short time horizon of a typical 529, about 18 years. Number 3. Invest using robo-advisors. We have talked about how to invest in equities through S&P 500 index funds and how to invest in commercial real estate through REITs. You can always use a robo-advisor if you'd rather not learn the ropes of investing on your own. An automated internet investment platform handles the actual investing on your behalf. It comprises constructing your portfolio, then managing it from now on. They even reinvest earnings, periodically rebalance your portfolio, and offer numerous tax methods to minimize your taxable investment profits. Furthermore, robo-advisors can be used with both taxable investment accounts and retirement accounts, particularly IRAs, for optimal investment management. Investing can be done without any involvement on your part. All you need to do is fund your account and the robo-advisor handles all the specifics for you. In addition, they frequently hold a variety of different investments. Many also provide access to funds that specifically invest in ESG stocks. Number 4. Improve your skills. In most cases, people don't view investing in themselves by way of acquiring new talents. Yet it can be one of the best investments you make as a young person. Earnings during a lifetime are likely to be the primary source of financial security. Its worth rises in proportion to the effort put into expanding it. You should budget some time and money to learn any new skills you'll need for your job. You can also give some thought to the additional abilities you'd like to acquire in order to position yourself for a future career change or a higher paying job. One may always improve their skill set by enrolling in further training programs, taking extra college courses, or ordering online courses. Yes, there will be an initial financial outlay, but if it can boost your future earnings significantly, it will be money well spent. That's a financial commitment in every meaning of the word. Number 5. Buy fractional shares of stocks or ETF. These days, purchasing stocks or ETFs doesn't need purchasing a full share. Try looking into fractional shares if you're interested in active investing but don't have a lot of money to put into it. This is the practice of purchasing a smaller number of shares of a stock at a reduced price. If you want to invest in Netflix but don't have the $500 required to acquire a single share, for instance, there is another option. The alternative is to invest $20 and acquire a tiny fraction of that single share. Even if you only have a fraction of a share, you are still a part owner. You can't buy fractional shares with every trading software or broker. Public.com, a commission-free stock and ETF trading software for iOS and Android, is a terrific app that will also allow you to buy some shares. It also allows for the purchase of ETFs and stocks in fractional shares. Number 6. High Yield Savings Account. If you want to earn more money on your funds, open a high-yield online savings account. High-yield internet savings accounts are easily accessible, much like the penny earning savings account at your local bank. Those who will require access to funds in the near future might be wise to open a savings account. Investors who are wary about losing their money can benefit from a high-yield savings account for the same reasons. You can rest assured that your money is safe in these accounts because they are offered by banks that are FDIC insured. Like certificates of deposit, CDs, high-yield savings accounts are generally thought to be secure investments. However, if rates are too low, you could see your purchasing power erode over time due to inflation. Since online banks have lower expenses, they can offer substantially greater interest rates. Number 7. Series 1 Bonds. In 2022, the Series 1 bond issued by the US Treasury is one of the most sought-after investment options available to individual savers. Having this bond can serve as a hedge against inflation. There is a fixed interest rate with an inflation adjustment added to it. As a result, the dividend will increase along with inflation, but as inflation decreases, so will interest rates. Each 6 months, the index is reset to reflect current inflation rates. Series 1 bonds, like other government-issued debt, are appealing to risk-averse investors since they carry no possibility of default. When looking to hedge your portfolio against inflation, these bonds are a viable option. However, investors can only purchase a total of $10,000 in Series 1 bonds every calendar year. Additionally, investors can use up to $5,000 of their annual tax refund toward the purchase of Series 1 bonds. There's also a well-kept secret for going over the yearly cap. The Series 1 bond mitigates one of the main risks associated with buying bonds, generally speaking, inflation. These bonds, along with other government-issued debt, are thought to be extremely secure against default. Number 8. Pay off your debt. Debt is a huge hindrance to young people's ability to invest. The average amount of student debt in 2021 is about $38,000, and many young adults carry substantial credit card and auto loan balances. Debt is bad since it cuts into your income. A monthly income of $5,000 would leave only $4,200 after paying $800 in debt. If everything were perfect, you wouldn't have any debt. This isn't a perfect world, and you know it. For those with debt who also wish to invest, striking a reasonable balance between the two is essential. It's tempting to promise yourself that you'll only pay the bare minimum on your debts and put the rest of your money toward investing. That will make it much easier to reap the benefits of investment income compounding. Yet, there is also a discrepancy. Loan interest rates are set, but investment returns are not. To rephrase, if your portfolio drops 10%, you'll still have to pay 4% on your vehicle loan, 6% on your education loans, and 20% or more on your credit cards. Consequently, starting to pay off debts early in life is one of the best investments you can make. Paying off credit card debt should be step 1. Credit card bills typically have the highest interest rates, despite being the smallest loans people hold. To put it another way, if you're paying 20% on a credit card, you shouldn't expect to gain 20% on your assets on a regular basis. The smartest decision you can make to reduce your debt is pay off your credit cards. So, what are your thoughts about these investment options? Tell us in the comments. Also, if you like this video, then make sure to watch this next video on our channel. Thanks for watching. Bye.